Welcome back to Basic Business Training 2, where we will be continuing our discussion on bookkeeping and money management as we begin going deeper into the accounting equation that we introduced you to in the last session. And we want to look today how that can apply to the income statement that we want to be able to put together as a good report for us to have good knowledge of what our business is doing financially. I want to start the session by looking specifically at Hebrews 12, verse 11, which says, "No discipline seems pleasant at the time, but painful. Later on, however, it produces a harvest of righteousness and peace for those who have been trained by it." And one of the things that I have seen in working with businesses now for close to 20 years is that as people learn to keep a budget and to review their finances and develop the discipline of money management, there is a harvest of righteousness. There is a harvest of peace that comes along because you are able to know what is happening, you are able to make good decisions, and you don't have to fear for the future as you begin to build in your savings, your emergency savings, as you begin to prepare for the next growth that can happen, and you're managing it. And you know before God that you are being a steward of what He has given you. And so this is definitely something that we encourage you to take the time to do, to hold each other accountable, encourage each other to take these small steps that we're recommending that you take simply by recording every day what is happening and keeping track of that paper trail and then checking in with each other and encouraging each other to stay the course until it becomes a habit that you will begin to actually think it's not so bad, and you might even enjoy it because you know that your business is growing, that your family is flourishing, and that you are being blessed in order to be a blessing. And so we remind ourselves that we are still working on the roof of our business and moving towards having a good roof that will give good protection for the business in terms of bookkeeping. And at the end of the last session, I told you that in this session, we would introduce you to a business called SoftByte. And byte is spelled B-Y-T-E, like a megabyte, a gigabyte in a computer. And this is a new computer programming company that was started by Ray Neal. And so I want to introduce you because we'll be using this example over a couple of sessions as we look at how he keeps his finances as well as his income statement and his balance sheet. But I'm going to walk you backwards just for a minute and also help you to know that Ray has written a vision statement and a mission statement, and he has goals for his business according to the quadruple bottom line. And so you can hear and think for yourself whether this is a good vision statement and a good mission statement and whether his goals are smart. So the vision statement for SoftByte, remember, a vision statement is something that where we see the future is different because our business exists. So what is Ray imagining that his business, SoftByte, what potential will it have on helping this world to flourish? And he says that this is his vision statement: to inspire and nurture the human spirit through technology possibilities, positively contributing to a changing world that can flourish through technology access and opportunity. And so he's saying that the human spirit will be nurtured and inspired as technology helps us to organize ourselves and create opportunities for ourselves. And so that is his vision statement. His mission statement, if you remember, a mission statement is what tells us how we will accomplish the vision. And so Ray said that this is his mission statement: we deliver innovative technology and services that make businesses better through a powerful combination of customer knowledge, inspired thinking, and attentive associates. And so this is how he is going to help his business to make that vision a reality. They want innovative technology and services. They are going to be working with what they learn from their customers and have inspirational thinking and good associates who will be able to help them. And so that is Ray Neal's mission statement and vision statement. Now, his goals, and if you remember, way back when we talked about the three great directives, and the three great directives were the Great Commitment, the Great Commandment, and the Great Commission. And from the Great Commitment, there are two goals that we want to work on. And the first is an economic goal, and the second is an environmental goal. And our hope is by now you've written your own goals for your business and at least two economic goals. If you can do two for each, that would be great. And remember that we want these goals to be SMART. They need to be S, specific, M, measurable, A, attainable, R, realistic, and T, time-bound. And so you can judge for yourself how Ray did with this. But for his economic goals, remember that this is a new business, and so it's primarily around marketing at this time. It's not going to be growth of sales because he's just starting out. But his first economic goal is to add 5 new customers every month for the first year of operations through marketing, networking, and personal outreach. And so you can analyze, is that a specific goal? Is it measurable? Well, maybe he could be more specific. Is it measurable? Yes, you can add up whether he had 5 every month. Is it attainable? That's something I don't know because I don't know where he's located or his context. Is it realistic for him? Again, I don't know his situation. That's more of an internal decision. And is it time-bound? Yes, it's for the first year of operations for the first 12 months. So it's a relatively SMART goal. There are some things that we don't know. The second economic goal that he has is to provide excellent support to each customer by reaching out to each client twice per month through phone calls, visits, or email, even after the contract has ended, to check in to continue customer satisfaction. These interactions will be logged in company database and will be reviewed monthly by the owner. And so this is, again, I think this is a pretty specific goal. They want to continue to nurture that customer relationship and help those customers to become partners or clients at least, where they have a loyalty and recognize how this business can help them. So it's specific, it's measurable. They are going to contact each client twice per month. Is it attainable? It sounds like it probably could be. I don't know how many staff this person has to start the business. If it's just him and he's starting out, it's probably doable. Is it realistic? It might be realistic for the first year. We don't know as the number of clients grows how realistic that is. And is it time-bound? Yes, he says twice per month. And so we see 2 economic goals there. Environmental goals. What are his goals to help protect creation? And the first is to use paper carefully to reduce wastage and contribute to deforestation. And then under that, he wants to recycle all used paper. And so he's recognizing that in his business, he's going to be using paper as they are drawing out plans and talking and working and presenting contracts. And his goal is to recycle. But his second goal is to do this, to plant 10 trees every month to give back to the forest for the paper that they do use. And so recognizing that that is something that he can do, I'm not sure if he's contributing for somebody to plant those trees or if he themselves as a company are going to be doing that, but that is part of his environmental goal. Then a social goal, and now we move into the Great Commandment. And remember, we are told to love God and love our neighbor. And so his social goal, if you remember, God has given us 3 key resources, time, treasure, and talent. And so as I think about loving my neighbor, it doesn't just have to be financial gifts that I'm giving. It can be my time, volunteering for different ministries or programs. I can also give of my talent. And that is what we see in his first goal, is that he is going to love his neighbor by giving of his talent. And so the first one we see here is to offer programming services to one church or Christian NGO or nonprofit every quarter for free. And so that is going to be part of his social goal, is how can I take the technology information that I have and that I know and make it a gift. That's going to be a gift of time and of talent. And then the second one is to provide one opportunity per year per employee to flourish and grow by providing time or scholarships for ongoing learning and development in their chosen field. And so he is seeing also that his neighbor is his employees, and he wants to support them, that they continue to grow and develop in their gifting. Lastly, we look at the missional goal. And for the missional goal, we, of course, go back to the Great Commission, and we are to work on ourselves for being a disciple as well as for making a disciple, recognizing and remembering that if we are not living out being a disciple every day of the week, it makes our testimony for having someone to become a disciple much more difficult. And so you can see that in Ray's goals. His first goal, as it relates to the missional bottom line, is to be a better disciple by increasing my own discipline in bookkeeping in my family and in the company for better transparency, accountability, and ultimately integrity. Now, I don't see a timeline on this one, and so he could improve this goal a little bit, but he's saying that he's admitting that this is a struggle for him to do bookkeeping well, and he wants to be a better disciple, a better steward of what God has given him by working on that and developing that. Again, we don't know how he's going to do that, and so we could push back a little bit on this goal for that. But his second goal then is to pray for the businesses around him every day for the next 30 days and to be open to what the Holy Spirit might do as I pray. I will be open to the opportunities, he says, for conversations with these businesses and be prepared to take time should those conversations present themselves. Now, that's a challenge. Again, you're doing business and you begin intentionally praying for people. And what happens when we do that is the Holy Spirit is also beginning to move in those people, and they may come and present themselves with a problem or an opportunity or a conversation. And I know for myself that, I usually have an agenda and I have a place that I'm going. And so if somebody stops me, my temptation is to look at my watch and I need to get going. And what Ray is saying in this is that I want to be prepared to take the time should those opportunities present themselves. And so he's making himself available. And so those are Ray's goals. And so you can see how that might look different for every person according to those four. But this is his soft bite business, and this is what he is looking to do. And so now in your book, you will see a list of transactions. And what we want to do now is to go back to that accounting principle, that accounting equation that we looked at the last time, and begin to work that accounting equation out as we record the transactions for Ray's business. And so this is a different way of record keeping according to the accounting equation, different from the one we presented earlier with those different boxes. So this is a way of keeping records that is going to record both cash transactions as well as non-cash transactions. And so as a reminder, at the top of that chart in your book, you will see the equation, which is assets equals liabilities plus owner's equity. Underneath that, you will see a few different columns. And I want to remind you that every business might have different types of assets. Every business might have different types of liabilities, and the owner's equity has usually four main categories, but even that can be broken out broader depending on the business. And so the categories, the columns that you will see are unique to Ray's business, but they might be similar to yours depending on the type of business that you do. And so underneath assets, we see that Ray has four different assets that he's going to be tracking. The first, and I think every business will have this, is cash. And of course, the cash in that column is going to go up and down depending on whether we are receiving cash or we are paying something out in cash. The second column is the accounts receivable. And so Ray is in a business where customers might not pay him fully for the services. And so that's a non-cash transaction, but it still is a sale. It still is revenue. And so he will record what people owe him in that category. And again, that category is going to go up, meaning when people owe him money, but it will also go down when they pay him that money back that they owe. And we'll talk through that as we go through an example. The next column is the supplies, and in the supplies is where we are seeing that we have things to help run the office. Ray needs to run this office. There are supplies that he might need. And again, this column, it will go up when we buy supplies, but as we consume and use the supplies, that number will go down at some point. And then the last asset that he is tracking is equipment. And for Ray Neal, of course, doing a computer center, he has computers, he has printers, he has equipment that he has, and usually we purchase that. It's an asset. Eventually, those will be depreciated. That will show up on the balance sheet, and so that column will stay pretty much in the positive, not subtracting. And so we have assets equals liabilities. And so then we look at the liabilities. And at this point, all Ray has listed here are accounts payable. That means that Ray has not taken a long-term loan, a loan that goes longer than 1 year. It means he also does not have a short-term loan, which is usually less than 1 year. What he has are accounts payable, and those are usually things that we have to pay within 30 days. So if you take something on credit, you pay it back within 30 days. If you owe somebody money in terms of a bill that you've incurred, usually pay it back in 30 days. That gets listed there. So again, it's a positive number when we incur the liability, and then as we pay it down, we subtract from that so that the liability that we owe decreases. The last part, the 4 columns for owner's equity, as we talked about the last time, we have the owner's capital. How much did the owner put in initially and subsequently as an investment into the business? Then from there, we subtract the owner's draw. Anything that you take out of the business for yourself gets subtracted in that line. When you have a sale, that is your revenue, whether it's products or services. It gets added to the 3rd column under owner's equity, revenue. And from there, we subtract any expenses, any cost of doing business. So let's go through these transactions, and again, we'll take it step by step. And what I would love for you to do is, even before you hear me give the answer, that you might pause and discuss amongst yourself where you think the answer would be, and then see whether you're right. If you do have the answers in your workbook, I would encourage you not to look at them, because you want to force your brain to do the work on this, and looking at it's too easy, and your brain will be very satisfied that you get it when in fact you haven't struggled with it. So the first transaction is this, that Ray Neal decides to open a computer programming service, which he names SoftBite. On September 1, Ray Neal invests $15,000 of cash into the business. And so as you are thinking about assets and liabilities and owner's equity, you have to ask yourself the question, what changes because Ray Neal invested $15,000 into the business? Well, we know that all of a sudden we have $15,000 cash. SoftBite has $15,000 of cash, and we know that cash is an asset, and so we record that in the cash line. That cash goes up $15,000. But then we know the equation, assets equals liabilities plus owner's equity, and we have to say, where did this cash come from? How can we explain that SoftBite suddenly has $15,000 cash? Was a loan taken? No, nothing is under liabilities. What we know is that the owner invested capital. So under capital, we also put plus $15,000 because the owner put the capital in as cash, and so that's how we explain it. All right, so $15,000 goes under cash, $15,000 goes under owner's capital. Transaction 2. Now, purchase of equipment for cash. SoftBite purchases computer equipment for $7,000 cash. So what changes? Now, Ray goes out and he buys the computer equipment and he pays cash for them. So we know that cash is going to go down by $7,000. What else changes in the business? Well, suddenly we have computers, right? Where did those computers come from? Well, they came from cash. And so equipment now goes up by $7,000. And so what we're seeing in that transaction is that Ray Neal took one type of asset, cash, and he just changed it into another type of asset, equipment. Financially, nothing overall in terms of the bottom line changed in the business, but Ray just took one asset and turned it into another form of an asset. So cash goes down by 7 and equipment goes up by 7,000. Transaction 3. SoftBite purchased for $1,600 from Acme Supply Company computer paper and other office supplies that are expected to last for several months. This purchase is made on account, which means it was made on credit. So Ray went out to the Acme Supply Company and got about 3 months' worth of office supplies. And so we suddenly have office supplies in the amount of $1,600 in the building. And so that's an asset, right? These are things that we need to run the business. Those are tangible things that we can see and touch. How do we explain that we have this? Well, not cash. Cash did not go down because we paid on credit, and so our liability goes up $1,600. So we record that we have supplies in the amount of $1,600. And now we have a new liability that explains where that asset comes from. So I hope that you're starting to see that the beauty of this equation is that it tells a story. Everything that the assets that we have can be explained by looking at these transactions. And so it's a double entry system. We're entering it in twice because we're telling the story. Where did it come from, and how do we explain that it came there? The next one, transaction 4, SoftBite receives $1,200 cash from customers for programming services that it has supplied. So Ray finally gets his first job. It's 1 out of the 5 that he wants for the month. This is great. He does the work, and the customer actually pays cash. And so this is a good thing. And so cash has gone up $1,200. We enter it into that column. How do we explain that's cash? Where did this cash come from? Well, now we know it's not a liability. It's not owner's capital. It's not an owner's draw, of course. And so we see it's revenue. This is revenue. The service has been provided, and so we enter it under revenue as $1,200 that was received, and that explains why our bank account has gone up $1,200. Transaction 5, SoftBite receives a bill for $250 from the Daily News for advertising, and of course we receive the bill. He sets it on his desk for payment later. What changes in the business? Now, no money has come in or come out, but suddenly SoftBite has a liability, right? They have a bill, they have an accounts payable that needs to be paid. And so we have to enter that in as a liability of $250 that we owe to the Daily News for advertising. But how do we explain this liability? Where does it fit into the whole picture? It's obviously not an asset. Marketing is an expense, right? And so we can see that right next to the revenue column, we have an expense column. And so where did this liability come from? Well, it was an expense that was paid. And when we look at our transaction notes, we see that it was for marketing. And so the liabilities go up $250. We have another $250 that we owe. And our revenue is located, or almost always put in as a negative, a minus $250, because we will subtract our expenses from our revenue eventually. And so minus $250 under the expenses. One of the things I want you to think about in that last transaction is sometimes we think about algebra and we think what happens to one side has to happen to the other side, but that's not the case with the accounting equation. Both of these things are happening on the right side of the equation, liabilities and expenses. And so don't think that it has to be on both sides, but it does have to enter twice in order for us to tell the whole story and be complete in the story that we're telling. Transaction 6, SoftBite provides $3,500 of programming services for customers. Yay, second customer in a month, we're doing good. And so the customer, the Ray SoftBite, the company, receives of the $3,500 that they are owed. The person says, I'm going to pay you $1,500 in cash, but can I pay you the rest later? Is it okay if I pay you the rest later? And Ray says, that's fine. So we have a revenue, right? We have another sale or service that's being performed. And so under owner's equity, we can list $3,500 as a revenue. But we did not receive the full amount of that money. And so what we did receive was $1,500 in cash. So cash goes up $1,500, but the person still owes us $2,000. So where does that get listed? Well, we know that accounts receivable is the column where we list out that we did have a revenue, but they still owe us that money. And so under accounts receivable, we put $2,000. And as this person will pay that down, our cash will end up increasing, and the amounts receivable will decrease. And so for now, we have a plus $1,500 in cash. We have a plus $2,000 in accounts receivable. How do we explain where these $3,500 of assets come from? We go over to the owner's equity, and it's listed as revenue. The next one, SoftBite pays the following expenses, number 7, in cash. So the SoftBite gets 3 bills for the month of September, and they pay these 3 bills in cash. The store rent was $600. The salaries of employees was $900. And utilities was $200. And so Ray gets to work and he's going to pay these bills. And so we see him paying the rent for $600 and we see cash go down by $600. How do we explain where did that cash go? Well, we have an expense for rent, and so it gets recorded minus $200 under the expenses. The next one, he pays his salaries for September, and so we see, again, cash goes down by $900. How do we explain where that cash went? Well, it went to another expense, and so the expenses get minus $900 in there. Lastly, he gets his utility bills. Cash again, he pays cash for it. Cash goes down by $200. How do we explain where that money went? We can go all the way over to our expenses because utilities are an expense. It's a fixed cost, and our expenses are marked as minus $200. And so we have an explanation for why cash is changing by looking at the rest of the accounting equation. Transaction number 8, SoftBite pays its $250 daily news bill in cash. So if you remember back to, I think it was transaction 5. Transaction 5, they got a bill for the marketing that they did in the newspaper saying, hey, SoftBite new business, come and use us. And they said, we're not going to pay that now. It's going to be a liability. It's part of our expenses. Now Ray is going to pay that bill. And so we see that cash goes down by $250 because that was the total amount of the bill. The next part of where to record it next can be tricky, and I've seen people struggle with this. Some people want to put it in as an expense, but we already put it in as an expense in transaction 5. And what we did in transaction 5 is we said this is an expense for marketing for the business, and we're not going to pay it right now. It's going to be a liability. And so now that we're paying this in transaction 8, we are going to pay this. So what gets deducted is the liability. So the liability goes down by $250, and of course cash goes down by $250. Last then, or not last, second last, transaction 9, SoftBite receives $600 in cash from the customer who had been billed for services in transaction 6. Now remember, you had a customer who said, I'll pay $1,500 now, and I'm going to owe you $2,000. Now that customer comes in with a partial payment, and they give you $600 of the money that is owed. And so cash goes up $600. Where do we explain that this money came from? Well, we had that $2,000 that we were owed in accounts receivable, so now we need to put minus $600, and we will see that the amount the customer now owes us is going to be $1,400. And so we enter it in that way in both places. We are taking an asset, accounts receivable, and we are turning it into another asset, which is cash. And of course, cash is always better. The last transaction is that Ray Neal withdraws $1,300 in cash from the business for his personal use. And so cash goes down. It's at the end of the month. Cash goes down by $1,300. How do we explain where that cash went? Well, we can see over in owner's equity, in owner's drawing, minus $300. And so cash goes down because Ray Neal made a withdrawal for his own personal use as the owner. He can do that. It's not a salary. It's not a fixed cost or an expense. It's an owner's drawing. And so it gets entered in under the owner's drawing. And so now, if you were to total all of those columns up, you will see that cash is going up and down and up and down and up and down. And if you look in your column, hopefully you've been filling these out and you add it up, you will see that at the end of the month, Ray ends up with $8,050 in cash. Hopefully that is what you have seen for yourself as well. In accounts receivable, we know we had the one client who owed $2,000. They made a $600 payment, and so what we're left with in accounts receivable is $1,400. In supplies, we have not had the transaction yet where we look at how much of the supplies we have consumed, and so we know we purchased $1,600 in supplies. That is what we are left with at the end of the month. And then the total amount of equipment is the last asset, was $7,000, and so we're left with $7,000. And so now we add up all of the assets. Assets of cash, accounts receivable, supplies, and equipment, and we come up with a total of $18,050. All right, and so assets are $18,050. Now we look at what it equals. Assets has to equal the same amount as the liabilities plus the owner's equity. And so under liabilities, we remember that $1,600 in supplies, we took that on credit. We haven't made a payment yet. We did also receive that bill from the Daily News that we ended up paying off. And so now if we add up our liabilities, we owe a total of $1,600. Owner's capital, we have Ray that put in $15,000 at the beginning of the month. That remains the same. Owner's drawing, we subtract what Ray took out for himself, which was $1,300. The revenue, we only had 2 clients, so we had a goal of 5, but we started with 2. That's not too bad for the first month. Maybe we can make up for it in later months. But a total amount of revenue, if we add up $1,200 plus $3,500, we see a total of $4,700. And our expenses then, if we add up the marketing, the rent, the salaries, and the utilities, we will see a total amount of expenses of $1,950. When we add up our liabilities, $1,600, plus our owner's equity, which is the liabilities $1,600 plus $1,500 minus the drawings of $1,300 plus the revenue of $4,700 minus the expenses of $1,950, lo and behold, we get the same number of $18,050. And so we can see that our assets have equaled our liabilities and owner's equity. Remember, we said plan, do, and review. And part of our process is if we are not reconciled, if these two numbers are not the same, we have to go back and figure out where we went wrong. And it takes some practice to figure out how to enter these in a way that makes sense. And that's why I encourage you to ask the questions of yourself, especially with cash going up and down. How do we explain that this happened? And it should make logical sense as you look at that. And what's beautiful about this is that this picture that you are seeing right here, $18,050, will very easily be able to be transferred into an income statement and as well as into a balance sheet. And it becomes very easy if you can use this type of transactional analysis. But, one of the things I would ask of you is, what do you think? How did Ray Neal do? If you were if this was your company and now you were to plan, do, review, and you're reviewing, what would you think? He started the business with $15,000. He ended now with assets in the amount of $18,050. And so you think to yourself, well, that's good that the number went up, and that's a good thing. The only thing that you have to be careful about is how much of that is in liabilities. And in liabilities is $1,600, and so he does not have a full $3,000 worth of profit, although sometimes we might think that because that's what we are seeing. We actually have closer to about $1,500, $1,400 of profit. And that's not a bad thing. He also was able to take a good amount of money for himself and pay himself or however he used that owner's draw. But it's something that you would look at. And if you were sitting, and Ray Neal was sitting across the table from you and you were to advise him, I don't know what you would say. And maybe you would say, that's great that you got the 2 clients. What can you do now to help those 2 clients multiply into 4 clients? Or maybe you'd say, that was kind of a big amount that you took for your owner's draw for the first month. Maybe you want to back off on that a little bit and make sure that maybe pay down that liability as opposed to taking that for you such a large amount in the first month. But anyways, these are conversations that you can have as you think about this example and think about Ray's vision statement and mission statement and his goals. And what does that look like for you as you begin to move forward? We will have more of these examples that you can work on. There's 2 more in your workbook that you can go through for yourself to practice because, of course, practice makes perfect. And it's easier to practice with another company, with another business, and with each other as you go through it to try to wrestle through it. But I want to tell you, if you can manage doing your reporting, your transactional analysis using this methodology, doing your rest of your income statement and your balance sheet will be very easy for you. And in our next session, we will look at that, how Ray can easily make an income statement and a balance sheet from using this form. Thanks so much for being with us. I hope this made some good sense to you and that you're getting excited about accounting, and we will see you next time. God bless.